Alright everybody, today we're talking about QYLD. It's an income ETF. Pretty cool. We're going to break it down. How are they making money? What are they invested in? What happens if they don't make money on their options? How is it taxed? How can you use this to retire? What are alternatives to using QYLD that give you more growth potential? A lot of information packed in this video. The main goal of QYLD is to generate monthly consistent income for shareholders. And if you need cash flow, this could be a great addition for your portfolio. Maybe you're trying to replace your job because you are retiring and you want that monthly income coming in. So it does this by selling covered calls. And to understand what that is, the very short version of that is they're making promises to sell an equity at a higher price in the future if that equity is above that price. And how that works is if the equity goes above that price that we say we're going to sell at, we lose out on any gains beyond that, and the buyer of this contract can exercise to buy that equity at a lower price, and that's how they get their gains. So ideally, when we sell these, we want the Nasdaq, or in this example, the Nasdaq, we want it to be below that price on the date of execution so that we just keep all the money we got paid for that contract, and we don't have to give up the stuff. If you follow my channel, you know I use selling options as a main source of income. And that's basically what this is doing, but using only call. QYLD has been running for at least 7 years, and it's paid out a monthly consistent dividend, so it's doing exactly what they promised to do. And it's doing this by selling those covered calls on the Nasdaq 100. And what that means is you don't have to do it yourself. Someone else is already doing that for you. You just invest money into this ETF, and they'll generate more income for you. Some of the top holdings here, you can see they're all good large cap companies that you've heard of. You got Apple, Microsoft, Amazon, Tesla even. Like, these are companies that are not going to go bankrupt anytime soon. Hopefully, knock on wood. All right, so what exactly is QYLD doing? They're selling covered calls on the Nasdaq 100 index option. And when they do this, they receive income or premium for doing that. And then at the end of the month, they distribute that to the shareholders every month. It's really that simple. They're just selling covered calls, taking that premium, and you get that cut. Here's a picture that's on their website that shows exactly that same thing. They're selling it every month, monthly options. Wait for it to expire or settle, distribute money to you, and repeat. That's what QYLD is doing. So you don't have to do this yourself. It's doing it for you. They're doing this on the European options market. So these options that they're selling, they can only be executed on that date. They can't be executed before that. So if the underlyings go up, above, and down, below, right before expiration, like, we don't care about it going above during the life of the contract. We only care what the price is on the date of expiration. And then if we're in the money and we have to deliver those shares, what they do instead for QYLD is they settle in cash. They don't actually get rid of the underlines. So they still keep everything that they own. They just pay out the cash difference of what they would lose. Some market scenarios in a downwards market. Here you can see they sell a covered call. If the market ends down in the month, then we keep that premium that they sold, and we get that as a dividend. A flat market, same scenario. We don't care if it's up or down throughout the life of the contract because it only matters on the date of expiration. If it's at or below, we keep our premium. We made that monthly income. In an up market, this is where it gets a little tricky. So in this example, QYLD would lose, and they would have to pay cash to get out of that contract because we were wrong, and the Nasdaq 100 is above our strike price. So they pay cash to get rid of that. And then as a result, they end up doing a return of capital for you as a shareholder because they want to make sure that you get that monthly income. That's their main goal, is to provide you that income. So QYLD does have a small measure of protection to the downside. And here's a couple examples from their website where they show that QYLD didn't drop as much as the Nasdaq 100. But when I'm looking at this, I'm seeing that during most of these drops, QYLD does drop pretty close to the same amount that the Nasdaq 100 does. So not that much protection going on here in my eyes, but that's a little bit better than if you were just holding those stocks yourself, because what's happening is when the Nasdaq 100 is going down, you're keeping that full premium from selling the covered calls. So that's why it's going to lag behind on the down movement a little bit. Some neat math here. Because the dividend is about 1% of the stock price a month, you can do some simple math to see how much money you'd be getting a month if you invest the money. Just move the decimal over 2 spots, and that's how much you'd be getting a month. So if you invest $22, you now get 22 cents a month for life, theoretically, assuming that the dividend does not fluctuate, which it will. But, pretty good guesstimate right here. Every $100 you put into the stock or into this ETF, you get $1. If you have 100,000, you get $1,000 a month, or about $12K a year. And that also brings up this neat scenario where you can determine how much money you need to live off of. So say you needed $50,000 in salary. What you can do is divide that by 12 to break it up by months. Divide it by 0.01 because that's the percent yield you're getting per month. And you can see if you invested $416,000, you would have a yearly salary of $50K through dividends paid out through QYLD, assuming that the dividends don't fluctuate. So it's kind of neat. Figure out how much you need to retire and just divide by 12, divide by 0.01, and then that's how much money you need to live off that salary. So that's a pretty neat thing, I think. In our Discord, there are some people that are using the margin to retire plan. And I'm going to say right off the bat, this is untested, so please be careful. Do your own research. And basically what they're doing is they're taking advantage of IBKR's 4-to-1 buying power and the 1% interest rate for margin. And what they're doing is they're taking their cash position, doubling it, and buying as many shares as they can using that cash. So you're essentially doubling your income that you get minus 1% for margin interest. Using this strategy to generate a $50K salary using QYLD, you'd only need about $210,000 because you're double that using margin. And they also talk about using other strategies. If you want to talk about inception, they could sell covered calls on QYLD to generate a little bit more income, or use that to pay the interest, or they use that to buy protection in case of a downside. So they'll buy puts below to protect them in case of the Nasdaq 100 dropping in a crash. So some neat things going in there. If you want to learn more about that, join the Discord. They're in there, and I'm sure they'd love to talk about it. All right, so let's go back to taxes here. So money earned from selling options is taxed at a 60% long-term and 40% short-term capital gains rate. If the market is bullish and our strike price gets breached, then they're not making income from selling those options, assuming they get past break even. So what they do instead is they'll pay out a special dividend that is a return of cash. And this essentially lowers your tax braces. And these payouts are actually free because they're just returning money that you invested. And what happens is when you go to sell these shares later, your cost basis would be adjusted based off the return of capitals that you've had. And that could affect how much you have to pay in taxes when you go to sell the shares. So if you plan on never selling these shares, then this is awesome because you're basically getting free income. But if you do decide you're going to sell these later, you might pay more taxes when you go to sell these shares. Because they're using this cover call strategy, they lag behind SPY because they're capping the max gains that they can get just by definition of selling cover calls. And here's a little chart that we found on an ETF comparison site. And you can see it drastically is behind QYLD. And it's because what you're doing is you're trading growth potential for cash flow when you're buying QYLD. So if you're near retirement, this could be a great fund because you care more about cash flow. But if you're like me and you have a long way to go before that, giving up that growth now for that cash flow just doesn't quite make sense. If I was living off the income I'm making from my portfolio, then maybe. But right now I'm not. Any income I make, I'm putting right back to use because I want to make it bigger. I want a bigger pie to eat from later. Now, one of the other funds that is in the QYL gang is QYLG. This is basically the same thing as QYLD, except instead of selling cover calls on 100% of their positions, they're only doing it on 50%. So the dividend you're getting from this ETF is going to be less, but you have more growth potential because half of the equities can still participate in that upside movement. If we're going to compare these two funds next to each other, QYLG does cost more. And if you look at the dividends, it's about 7 cents less, 6 or 7 cents less. And that makes sense because you're selling covered calls on only half the positions that you have. And if you look at the ratio between the two, so here you got a 0.5 ratio, here you got a 1 ratio, which again makes perfect sense in terms of math because you're only selling on 50%, so your ratio should be half of what you're getting over here. But the plus side is that QYLG doesn't lag as much behind the SPY. It does lag because you are selling cover calls on half your position, but it does participate in some of the up movement in the market. And here's a chart that just compares QYLG and QYLD. So obviously QYLD is down here, QYLG is up here. So this might be a different fund for you to look at if you want to get that consistent monthly income, but you still want to participate in market growth during a bull market. So in conclusion, I think this ETF is like really interesting because it's using options to generate income for its shareholders. If you care about cash flow and you don't care about potential growth during a bull market, then QYLD is great because it's giving you that cash. Brother to QYLD is QYLG. So you get a little bit less cash flow, but you get more growth potential. So another one that you should be looking at if you don't want to go all in on QYLD. And I think that wraps up this video. So if you made it to this point, then obviously you enjoy this content. So be sure to like and subscribe below. And happy trading next week, guys.